To remain updated with the latest business news, click on the bell icon.
Where will you invest your money to get some regular income? The most expected answer is fixed deposit. And why not? It is simple to understand and it gives you fixed return. But do you know about taxes? The interest income from FDs is chargeable to tax at the rate as high as 20 to 30% according to the tax slab you fall into. For example, if you invest rupees 10 lakh, then you can earn rupees 12,500 every quarter or rupees 50,000 every year at an assumed interest rate of 5%. Now on this 50,000 interest income, you also need to pay tax. Assuming you fall into the tax slab rate of 30%, it will work out to rupees 15,000. Now there is a way to reduce this tax liability to just rupees 457. How? I will let you know. The answer lies in SWP or Systematic Withdrawal Plan. Now you will ask me, what is Systematic Withdrawal Plan? Actually, it is just opposite of SIP, where you give a mandate to a mutual fund company to withdraw a fixed amount at regular interval. It might sound like a fixed deposit where you invest a big sum of money and in return you get payments at regular intervals. But similarities end over here as the tax liability of the two are quite different. Now you will ask why. It is because in mutual funds, units are redeemed every month to give you regular income. The redemption proceeds are made of principal as well as capital gain part. Now on the principal part, no taxation is levied, but on the capital gains part, taxation is levied. It is this reason that the taxability is much lower in case of mutual funds with SWP than in comparison of fixed deposits. Now let's understand with the help of example. I have taken the example of debt funds as they are the best option for regular income after retirement. One important point in case of debt fund is if you redeem units before 3 years, capital gains is taxable as per the slab rate, while long-term capital gains are taxed at 20% with indexation. So instead of FD, if you invest the same amount of rupees 10 lakh in a debt mutual fund at an NAV of rupees 40, you will receive 25,000 units. Assuming the debt fund will give 5% return per annum, the NAV will grow to rupees 40.50 after a quarter. Now, if you opt for quarterly withdrawal of rupees 12,500, you will be redeeming 308.64 units in the first quarter. Since only capital gains component will get taxed, which is 0.50, the value of your capital gains will be rupees 154. The tax on this amount will amount to rupees 46 at the rate of 30%. The same exercise will happen for the next 3 quarters. The yearly capital gains will amount to rupees 1,524 and the tax liability will come in at rupees 457, just 457, which is 97% lower than FDs. But before availing SWP, do understand that interest in FDs is fixed, while in case of debt funds, it is fluctuating because of interest and credit risk. Moreover, there is an exemption of rupees 10,000 under section 80 TTA on total interest earned that include your bank accounts, RDs and FDs. The limit is higher in case of senior citizens, which is rupees 50,000 under section 80 TTB. There is no such exemption on return from mutual funds. So take the exemption part into consideration while analyzing the tax benefits. So if you have made up your mind to invest in debt funds with SWP, the advice is to diversify your portfolio among fixed deposit and debt funds. And while parking in debt funds, go for the funds that invest your money in AAA rated instruments because it will keep your portfolio safe and give you dual advantage of lower tax and stable returns.
If you like the video, do like, comment, share and subscribe.